This weekend, the silence in the Persian Gulf is deafening. While news outlets speculate, the flight trackers tell the real story. Over 120 U.S. combat aircraft are converging on the Middle East. We are seeing a dual-carrier strike group posture, the USS Abraham Lincoln and the USS Gerald Ford, a level of force not seen since the 2003 Iraq invasion. But for investors, the million-dollar question isn't just will they strike, but what happens to the S&P 500 on Monday morning. Today we break down the massive military buildup, revisit the forgotten market lessons of the 2025 strikes, and identify the specific stocks that will move the most. This isn't a routine patrol. As of February 2026, the U.S. has deployed a specialized air supremacy package. Aviation monitors have confirmed 12 F-22 Raptors transiting from Virginia to Jordan, joined by 3 full squadrons of F-35As and 48 F-16 Wild Weasels, specialized in hunting radar systems. On the water, the USS Abraham Lincoln carries the F-35C Lightning II, while the USS Gerald Ford brings the world's most advanced electromagnetic launching system for rapid-fire sorties. This massive presence is supported by over 40 kilocoulombs-46 tankers, signaling that the U.S. is prepared for long-range, sustained strikes deep into Iranian territory, targeting not just nuclear sites, but command centers. To predict the future, we must look at June 2025. When the U.S. launched Operation Midnight Hammer against Fordo and Natanz, the initial shock was sharp but brief. On Monday, June 23, 2025, the S&P 500 opened 1.1% lower, and the Nasdaq shed 1.3%. Oil prices spiked 5% instantly. However, by Wednesday, the markets had staged a, quote, collective shrug. Why? Because the Strait of Hormuz remained open. Investors realized the conflict was contained, but 2026 is different. Iran has now deployed advanced mobile anti-ship missiles along the coast. If the strait is blocked, where 20% of global oil flows, we aren't looking at a 1% dip. We are looking at a potential 10% correction and a crude oil price north of $150. In 2026, the market isn't just a monolith, it's a web of dependencies. If a strike occurs this weekend, the ripple effects will go far beyond a simple dip in the S&P 500. Let's look at the sectors that will define your portfolio's performance. The direct losers, margins under siege. It starts with transportation and logistics. Companies like FedEx and UPS, along with major airlines like Delta, operate on razor-thin margins. In the 2025 strikes, we saw jet fuel prices jump 12% in a single week. If the Strait of Hormuz is even partially blocked, these companies face a double whammy: skyrocketing operational costs and a slowdown in global trade volumes. Then, there's the automotive sector. Modern cars aren't just steel, they are energy-intensive products. From Tesla to Ford, a spike in energy prices increases manufacturing costs at the factory level and kills consumer demand at the dealership. Who wants to buy a new SUV when gas is heading towards $6 a gallon? The surprise victims? Semiconductors and tech. This is where most retail investors miss the mark. High energy prices are deflationary for growth. Why? Because giants like Amazon and Google run massive, energy-hungry data centers. Furthermore, if geopolitical tensions escalate, we often see a flight to safety, which strengthens the US dollar. A super strong dollar is actually bad for big tech earnings, as their international sales become worth less when converted back to USD. The tactical winners, the safe havens. Beyond the obvious jump in ExxonMobil and Chevron, the real smart money moves into defense and cybersecurity. During the 2025 Midnight Hammer operation, Lockheed Martin and Raytheon didn't just rise because of bombs, they rose because the world realized that peace dividends are over. Expect high demand for missile defense systems like the Patriot and THAAD. Additionally, watch cybersecurity firms. Iran's primary tool for asymmetrical warfare isn't just missiles, it's cyber attacks on Western financial infrastructure. A strike in the physical world almost guarantees a strike in the digital world, driving massive contracts to security providers. So how do we close this chapter? We have to understand the teeter-totter effect of 2026. If the US strike is surgical, meaning it hits specific targets and Iran's response is limited to rhetoric, the market will likely see a buy-the-news event. We saw this in 2025. A 48-hour dip followed by a rally as the uncertainty was removed. In this scenario, the S&P 500 stays within its current channel, and the weekend risk evaporates by Tuesday. However, if we see a sustained escalation, an Iranian attempt to mine the strait or attack Saudi oil facilities, we are looking at a regime change in volatility. The VIX would likely sustain levels above 35, and we could see a 10% to 15% correction, dragging the market back to early 2025 levels. History teaches us that geopolitical shocks are rarely the cause of a bear market, but they are often the catalyst that reveals underlying economic weakness. If the economy is strong, it absorbs the blow. If it's fragile, it breaks. As we wait for the Sunday night futures open, remember, the most dangerous thing you can do is trade with emotion. Use this weekend to review your exposure to high fuel cost industries and ensure you have enough dry powder cash to capitalize on the volatility. The headlines will be loud, but the data is what pays the bills. Stay rational, stay hedged, and we will see you on the other side of the weekend.